Hello, welcome again, everybody, on our second webinar on IFRS 16 lease accounting. We had our first session a month ago almost, and today we will tackle on some additional topics and additional considerations. First of all, just some logistics, because we have some new people that have joined that have not joined the previous sessions. So everybody is muted, but you can always ask your questions through the chat button or through the question button. We will monitor that and we will then try to answer your questions during the webinar. If not, we will come back to you afterwards. After the webinar, you will receive a first poll, a very small survey which takes less than 1 minute. We would appreciate if you can complete because it helps us to improve our webinars. Also, the webinar will be recorded and will be made available afterwards on our website. If you go to our website and you go to Academy, below you will find our webinars that we have recorded. Also, the webinar from September on the first session on IFRS 16. The slides are available in the handout button. So if you go to your right, you will see a handout. There you can download the slides. And I have also added again the slides from the September session. If you would not have received them, let us know and we will give them to you, send them to you by email. So today, my name is Sam Verfaillie and I'm a partner at Finvision. And I have two people also joining who has quite some experience in IFRS 16. And they will also deal with certain topics. We have Anouk Meershaert, which is working in our IFRS and consolidation team, and also Hans Everhard, also working in our IFRS and consolidation team. So today, the agenda, we had our session from in September. So again, it's available on finvision.be. But today we will discuss certain additional topics, which with regard to when I sublease a lease contract, when I'm a lessee, but also a lessor, because I'm subleasing a part or in full the asset for a certain period in time. We will talk about a sell and leaseback transaction, which is quite important also. We will talk about the subsequent measurement. So we discussed in the first session when we need to recognize when it is in the scope, when we have an identified asset, how do we need to initially measure the liability and the asset? What do we need to take into account within the payments? Do we need to take account variable payments or not, in substance lease payments, fixed lease payments, etc. So that was all discussed in our session 1. And today we will see what we need to do next, the next month. What is the impact? What do we need to do? And then also, and that's something that will happen quite a lot probably, is how do we need to deal with lease modifications, so modifications in the lease contract. We will distinguish between two types of changes. We have changes that were already tackled or discussed in the terms and conditions of the lease, but we may have also changes that were not part of the initial terms and conditions. And these are lease modifications, and how do we need to deal with that? We will update you on the impact for COVID-19 because there's some specific guidance issued by the ESB with regard to COVID-19 and how you need to deal with, for example, certain rent incentives or rent-free periods that you have obtained because of the COVID-19 crisis that we unfortunately experience very actually now. And then finally, we will discuss the disclosures, which are easy and some of them are rather difficult. So I will leave the word to Hans, and Hans will start discussing subleases. Hans.
Thank you, Sam. So subleases, it actually is a situation where somebody initially has taken a lease up as a lessee, and then afterwards, immediately or subsequently, subleases again to somebody else. The question arises then, how should you account for that as the person in the middle, if you look at the top of the slide, who is both a lessee and on the other side also the intermediate lessor. So the clear guidance there is to see how should you classify the sublease at that moment and make the assessment whether you should, as a lessor, consider the sublease as an operating lease or on the other side as a finance lease. So when would you have an operating lease? That is the case when the head lease is a short-term lease and the short-term recognition exemptions have been applied, or applying the classic guidance from IFRS 16, which has remained the same as under IS 17 for lessors, is substantially all of the risk and reward transferred to the lessee, or does it remain with the lessor? If substantially all risks and rewards are transferred, then it is a finance lease. If not, you should consider it as an operational lease. So if it is considered as a finance lease, you should still keep your lease on your balance sheet. So otherwise, finance lease, the intermediate lessor will derecognize the right of use asset immediately, and it will recognize the net present value of the future lease payments on its asset side, and the difference will be accounted for directly in P&L. Substantially, the net present value will be evaluated for impairment, which is different than when you would consider it as an operation lease. There, the right of use asset of the head lease is evaluated for impairment. Important, if you consider it as a finance lease, although your right of use asset in the head lease will no longer be on your balance sheet and will be replaced by the net present value of your future lease payments you will receive, the lease liability you have on the head lease will still remain on your balance sheet and in line with IFRS 16. Okay, we move further. We have a specific example. Example here, an entity which is a lessee on the one side and intermediate lessor leases a building for 5 years, and the useful life of that building is 30 years. On its side, it subleases again that building for 4 years. So classification to consider, is it a finance lease or an operation lease as a lessor? Are substantially all the risks and reward transferred? In this side, it is important, if you have a lessee, you should refer to the right of use asset of the head lease and not to the useful life on the underlying asset. So in this specific situation, you will compare the lease term on your sublease of 4 years with the 5-year lease term you have in the head lease. And the comparison will not be made. So here we see that 4 out of 5 years are subleased. So we can conclude that a major part of the economic life of the underlying asset is subleased. So in substance, we have transferred all risk and reward. So we will consider it as a finance lease. If we move to example 2, there we will see a slight adjustment. Basic terms on the head lease are the same. So there's still a head lease for 5 years and the building is the same, but the sublease is only subleased out for 2 years. Again, we will make a comparison, making reference to the 5 years you have in the right of use set in the head lease. And then we will see there's only 2 years out of 5 years subleased. So the conclusion would be here that not the major part of the economic life is subleased. So we would consider it as an operating lease. Once you have made the assessment whether you will classify your sublease as an operating lease or a finance lease, we can consider as followed the consequences. If you would classify it as an operational lease, you will continue to account for your depreciation charge on your right of use asset in the head lease and also on the interest in the lease liability. And on the other side, you will recognize all lease payments you receive in the sublease as lease income. If you would consider your sublease as a finance lease, you will have both a finance income on your sublease and also an interest expense on the head lease. Important, a few other topics to consider. If you expect to lease or you are subleasing, you cannot qualify your head lease as a low value asset and exempt from presentation as a right of use asset. Also for the sublease, in principle, you should determine the interest rate inherent to the contract itself, but IFRS 16 allows, if you cannot determine it readily, you can make use of the interest rate included in the head lease, perhaps with some adjustments given the different circumstances the sublease might have compared to the head lease. As said in the beginning, the sublease could be done as from the moment of the inception or could be done subsequently. If both contracts are concluded at nearly the same time, then you should make reference to the guidance whether it should be considered as combining contracts, and if that is the case, you should account for it as a single combined transaction. That is key points on subleasing. Then moving on to sale and leaseback. Basically, in the past, sale and leaseback was an important source of off-balance sheet leasing, but since IFRS 16 became effective, that is no longer the case, because as IFRS 16 has foreseen, all leases come on the balance sheet with the exception of two specific situations on low value asset or short-term leases. First question to consider when you have a sale and leaseback setup is whether the transfer of an asset, the initial sale, should be considered as a sale. And there IFRS 15 make reference to IFRS 15 and the criteria that should be considered, whether or not the control on the underlying asset has transferred. The different criteria are listed up here. However, as was also the case for IFRS 16 and the lesser, you should not consider them individually, you should consider them as a whole. All relevant facts and circumstances should be considered, and important there is as well the specific additional options that might be foreseen in the contract. Key here is to see a lease transfers the right to control a specific underlying asset for a specific amount of time, but it does not transfer fully the control of the underlying asset. So there you see that specific clauses, and I've listed a few below, might have an impact on the eventual conclusion whether or not it is a sale. If you have a substantive repurchase option, then eventually the asset will always return to your seller. So in the end, the conclusion would there be, if it's substantive, that it is not a sale. Same basically applies for renewal options. If the renewal options extends and they're substantive for basically all of the substantial remaining economic life, or your renewal option is below fair value, which makes it nearly certain that it will be exercised at the moment, then there is no sale again, because the buyer lessor will not obtain control. It will remain with the seller lessee. Moving further, if there is a transfer of sale, then first of all, you need to account for the sale. So the seller lessee will measure a right of use asset arising from the leaseback. Later on, we will have a specific example which makes it more easy to understand the specific setup. It will be done at a proportion of the previous carrying amount of the asset, and the gain or loss that relates to the rights transferred will be recognized. So you will basically make a split up of the surplus value of your sale, and part will be included still in the right of use asset, and the otherwise will be recognized in the income statement. Important here is that the lease should be done, the leaseback should be done with the adjustment for off-market terms. So you will have to consider what would be a fair value, and any below market or above market terms will be considered or as a prepayment of lease payments, or on the other hand, as additional financing provided by the buyer lessor to the seller lessee. Will become more clear in the example we will run through later on. Example here. So the seller lessee will sell a building for 2 million euros and it has it in the books for 1 million euro at that moment. Subsequently, there was a lease back foreseen for 18 years at 120k per year, and there is an implicit interest rate of 4.5% in the interest. The fair value of the building is considered to be at 1.8 million. So let's first make a number of basic calculations we need to use. The net present value of the yearly payments is of 120k is 1,459,000. So in the example here, we consider that the sale is eventually a transfer. So here we will see the excess value, which is the difference between the sales value of 2 million and the fair value of the building, is considered as additional financing. So what happens then? We basically make a split up between the net present value, between the part which is considered as additional financing for 200k, and the other part is the net present value of the lease payments specifically. Both are in total 1,459,000. So we have a ratio considered of 14% and 86%. That can be used as well to split up the annual payment subsequently. What happens then? Here in the example, we will first see at that seller lessee initial accounting treatment. So the seller lessee will receive 2 million euros for the sale of the building. It will recognize a right of use asset of nearly 700k. I will explain how we come to that amount later on. And on the one side, the building which was in the books for 1 million euro will be booked out. A financial liability will be shown, which is the net present value of the future lease payments, and also a gain on the rights transferred, so a gain on the building sold. How do we come now to the 700k and the 240k? I think the other three amounts we already discussed. So basically, the value of the right of use asset is calculated as using the ratio between the net book value that was in the books, 1 million, compared to the fair value of the asset sold, and then multiplied by the net present value of the lease payments. So basically, a part of the gain on the asset sold, so which was 800,000, because the net book value of the asset was 1 million euro and the fair value 1,000,008, and the other 200,000 is considered as additional funding. A part of that gain will remain in the right of use asset that will remain on the balance sheet. And the difference then is included directly in your income statement as a profit on your building sold. Again, with applying the same ratio. Here we look at the accounting treatment for the buyer lessor. Again, the same example, a sale for 2 million euros, which basically means that there is a cash out of 2 million euros for the buyer lessor. That will recognize on the one side a building of 1.8 million, which is the fair value of that building, and a financial asset for the additional financing provided by the buyer lessor to the seller lessee. Afterwards, when the payments come in, it will be considered as leasing revenues, and then we will apply the same ratio we initially provided, the 14% and the 86%, to make a split up of the 120k to be considered part as leasing revenues and another part as interest income, and also a settlement of the financial asset. If the transfer is not a sale, then the seller lessee will continue to recognize the transferred asset, and it will recognize a financial liability equal to the transfer of the proceeds. That liability should be accounted for applying IFRS 9, which is the topic of our next webinar. The buyer lessor will not recognize the transfer asset because there has no sale taken place, but it will recognize a financial assets equal to the transfer of the proceeds, and then again the accounting should be done in accordance with IFRS 9. Important to consider as well for sale and leaseback transaction are the disclosure. The seller lessee is required to disclose any gains and losses arising from the sale and leaseback transactions separately from the gain and loss of disposal of other assets. So there should be a distinction on the profits on sale and leaseback transactions and of the normal disposal of other assets. Next to that, additional disclosure should be considered, providing further information. Those are to be considered, and it will all depend obviously on the importance and the materiality of the transaction. So the reasons why the sale and leaseback took place, key terms and conditions, payments not included in the measurement of the lease liability, and the cash flow effect, which is also an important part. That was all. I don't know if there's any questions so far. If not, we will take them later on, and I will leave the floor to Anouk, I think.
Oh, it's to me.
Okay, to sum that.
Thank you. Okay. Well, let's now talk about and discuss a bit more about how to deal with the subsequent measurement, and related to that also the impact of any modifications. And during the session, I will try to show you also examples through our global lease center tool, because you will actually see it then happening, what is actually being calculated and how it is presented. Okay. So what is the theory behind it? The right of use asset, once you have recognized, that's something we have seen in the first session, you have three options. It's not always an option, but I think most of the companies will use the cost model. The cost model will say that I will reduce my right of use asset with the accumulated depreciation and the or any impairments. Accumulated depreciation, which is based on mostly the lease term, or it can also be the useful life. Useful life will be the case in case you will become automatically the owner, or for example, when you have a purchase option which has been assessed reasonably certain. You will adjust, and that's something we'll see afterwards, the adjustment or the impact of the remeasurement of the lease liability. Remeasurement of lease liability that may happen due to a change in payments, or change in scope, or change in lease term that may or may not be already foreseen in the terms and conditions of the lease contract. Okay, the depreciation period, that's something I already told you, will be the lower of the lease term or the useful life. So in many cases, it will be the lease term, except of course, when you have a transfer of ownership or a reasonably certain purchase option. And also the depreciation rules of IAS 16 property, plant and equipment do apply. What is that? Will it be a straight line depreciation method, or will I use another type of depreciation method? This is all possible. A second, it's not an option, but it's a requirement, is that if you apply IAS 40 investment property on buildings, then you need to apply it also on your right of use asset, which is also in case a building. That's not something we'll discuss. I think it will be a part of another webinar, but know that if you have investment properties, when you're a real estate company, you may have to apply also fair value accounting on your right of use asset. And then the third option, which is an option, is that you're allowed to apply the revaluation model, which is foreseen under IAS 16. Of course, you need to consider it whether, because in IAS 16, the requirement is that you need to do it for the specific class of asset, and every asset that is included in this class of asset, you need to apply it. So it's not on a building or an asset in individual basis, but it's a decision on a class basis. So this is the accounting for the rights of use assets. Nothing difficult, I think. The lease liability. This is just a normal, which is a bit the amortized cost method. You will add any interest on the lease liability, and you will deduct the lease payments. And then also you will have it will be less or plus the adjustment to reflect any reassessment or lease the impact of a lease modification to the lease liability. Normally, for the lease liability, the interest rate is based on the discount rate that you have applied at the initial accounting. And when there's no, for example, no modification, you will not change the discount rate. So your interest rate will be fixed. But I will discuss a bit more on the next slides when you need to change your discount rate. And also, as you know, variable lease payments are expensed as incurred. So variable lease payments are not part of the cash flow basis that you use to measure your lease liability. Okay, so let's see an example here. So the lessee enters into a 3-year lease of a car, and it's a very standard one, very simple one, for 3 years from 1st of March until the 28th of February 2022. Here you have quarterly advance payments of 1,250, and then at the end of the lease contract, you have an option to exercise with the purchase option of 2,500, or you have an option either to extend the lease with 6 months. And then the interest rate, it should be not expense, but the interest rate implicit in the lease, which is normally the first element to determine the discount rate, if you know it, is 2.5%. So how do you see it? And I will drop now to the GLC, and I will show you how it will look like. Let me open this one. So that's what you will see here. What do we see here is initially this was measured at 2.5%. This is the period, and you see that the initial measurement is 14,460. And this is when we recognize at so the part of the first session, the asset will be 14,470, and the liability will be 14,470. At the first day, what we will have, the net liability will be, you see it's not exactly the same. The reason is because there's already 1 day expense allocated, 1 day interest expense allocated. That's why you see a little bit higher net liability of the month. What you then see is we do a first payment of 1,250, and this 1,250 will be a payment to reduce the lease liability and will be 30,000 interest payment. The next quarter, it's here 31st of July, but because it's the first, it's within the month July, but it has been done the 1st of July. You don't here in the things you don't see it. We have again 1,250, and then I have an amortization of my lease liability of 1,167, which is much less than here, but which is normal because I need to pay here 3 months of interest. So if you add up those 3, you will come up with the amount of 1,250, and that will be released. That's very easy how the lease will end. So we will recognize interest expenses and we will recognize an amortization to the net lease liability. And of course, also we will tackle the differentiation between short-term and long-term net liabilities for the period. And it ends at 28 February 2022, 3 years later. Okay. When I look to the right of use asset, you will see something very similar. Here is that I have my carrying amount. Here already I have deducted I have deducted 13 euro daily depreciation. So it's really a system who calculates per day here. So it's 14,470 minus 13, which will end up in here. And then you have your depreciations. You see here in the system also it's variable because he's calculated it per day. We have 31 days, we have 30 days. That's why we have a difference here. Okay, so I think that's a very easy example. I have tried to show it a bit here also into the table, but I think that the tool was should have been very clear how it's working. Okay. So, but then what happens? We may have modifications. And the first question is, what is a modification under IFRS 16? And that's important to know because this may trigger certain decisions and certain accounting. So what is a modification? It is a change in the scope of the lease or a change in the consideration. The consideration is the total sum of the lease payments added. The total of the lease payments, that's the consideration if that would change. So it's either a change in the scope. Scope can be the asset, or a change in the consideration of the lease. And here, very important, that was not part of the original terms and conditions of the lease contract. Let me here do some examples. For example, if I have a contract and there's a change in the index, in the contract it says, for example, my previous contract, and would say, well, this is a variable payment, and if the index changes, I will change my lease payments. It is an in substance fixed payment, so you will really consider it still, but you will exclude the index as part of the initial lease accounting. If the index changes, this is not a modification because it is part of the original terms and conditions. The variability due to the index was foreseen in the original terms and conditions. Also important then is I will not apply a different discount rate. Let me show you an example here how that works. If I think I have an example, let me see the contract, this one here. I will apply an index change, do a modification. In the tool, it's called a modification, but it's theoretically not a modification. And I will apply an interest rate. And I will say, yes, I do an interest rate as of the 1st of, I think there was a new interest rate, the 1st of December. So automatically he will calculate, he knows it's now the new value, and he calculates automatically the new amount. I will save it. And then I will just do the calculation. And here now you will see that in the tool, he has applied an index at the 1st of December. He applied an index, and you see that even my gross liability, but also my net liability discounted has increased. And this is because he has calculated the new lease payments that will come into the future. So my new lease payment is not 1,250, but has become 1,363 every quarter. He will use that, discounted that using the same discount rate, and he will come back based on the same discount rate. He will come add up with 11,950, and that will be your new amount. So you have a little change here, and the change which is also applied then to the right of use asset. If I go to the right of use asset, you will see also that we have a change, and you will see also an addition, the same addition here. So the entry will be debit right of use asset, credit lease liability for the difference in the new net present value of the future lease payments that you will have to do, taking into account the new lease payments after the index. Okay. Oops. That's it. So another one, an example of a modification is a reassessment of the purchase option. Is that a modification? No, because a purchase option was already in the original terms and conditions. And that's one that I have considered that it's not reasonably certain, so it has not been considered. If at a certain point in time it has become reasonably certain that you will exercise, that's what we call a reassessment. You will apply it and you will have a change in the consideration because I will add the purchase option to the consideration. There, actually, you also need to use a new discount rate in that case. Let me show you again in the example how that works. I have here a contract which I will show you contract components. I think it's I think it has been this one even. Let me see if I have a purchase option. Pay lease term. It's an extension option. I have a no, it's not. It's sorry, it's the other one here. It's this one here, I think, that has a purchase option. No. No. I didn't include the purchase option in the example, but let me just very quickly do it. I will say I have a purchase option here. So you see what will happen. Yeah. No, sorry, it's the lease purchase option. Yes, I will add the purchase option. Purchase option will happen 22/23 0 at the last day. It's for an amount of 2,500. I will first set it at not reasonably certain, so it's at the beginning. I will save it. Do the calculation. You see here it's calculated without purchase options. So it's still the same amount, the same example. When I now do, let me just save it to the database. Okay. When I now do a modification, I will say, well, I need to change. I will change here, and I will change the purchase option and modify the asset information and purchase option. I will reassess, and I will say I will reassess the purchase option. This one here that I've considered, it's reasonably certain now. As of when I did it, for example, it has been done at the end of December. I will close it. You see now what will happen. Just categorize. When you now look to the lease liability, you see again here at the end of December that we have a purchase option addition. So what you see here is that there's a purchase options added to the system. He will consider the purchase option of I think it was 2,500. He will consider it, and he will add the purchase option to the payments that will be received here. Of course, it is discounted back to here. So here in the net liability, you don't see 2,500. You see the discounted amount of 2,500 to today. So what it's worth. If you go to the difference with the lease liability with the right of use asset now, is that in that case, because I have become the owner, normally he should be amortizing, he will amortize longer. So what you will see here is that we still have a carrying amount at the end of the lease term, which is normal because I will the useful life of 60 months, so 5 years. So we'll still have after 3 years, 2 years to go to depreciate the assets. So that's how we deal. It's with the new discount rate, however, here that it's being calculated. All right. When I have a new purchase option, that's a modification because I'm changing the terms and conditions, and you will apply a new discount rate. When I reassess an extension option for an additional year, no, because it has been considered in the terms and conditions. Revise it. Change a lease term. I will change lease term. It's not foreseen. Yes, it's a modification. I will also use a new discount rate. I will have some examples afterwards on that. A change in the scope of the underlying asset. Also some examples when you am leasing a building, an office building, an office space, and I will add a number of square meters to the lease. Additionally, a new floor, for example, that's a change in scope of the underlying asset. It can also be an addition, or can also be a reduction or a decrease. So it's also a modification. A change in the lease payments, yes, modification, revise. And then you may have certain residual value guarantees. You may see that, for example, in cars, or you may see that, I have seen that in cars, and I have seen that in leasing of installations or certain machines. And for the case of the machine, where the lessee guarantees at the end of the lease term that the value, the price that the lessor will be able to sell that to another party will be minimum a certain amount. So you guarantee the amount. If it's less, I will have to do an additional payment to the lessor for the difference. If the amount of the residual value guarantee changes during the period, it's not a modification. And also you will not apply a new discount rate when you apply that. The residual value guarantee also often, it's difficult to know what will be considered also there. In my example, for the amount, yeah, today it may be that I'm saying, well, that's a fair price, that's a fair value, so I have no risk. Today, I have no indication that I will have to pay anything. So the lessor will be able to sell it at their price. But circumstances during the lease term may give you indications that due, for example, a market crisis in the machines, that you there's too much supply of those machines, or the technology is old, for example, that you may have a risk, and then you will change the amount and you will add an amount to your future lease payments, which is an estimate, of course. All right. I have added here no change. What you see with the star is it's not a revised discount unless the changes are due to a change in specifically related to a change in floating interest rates, and then you will calculate your new discount rate based on the change in the floating interest rate. But I haven't seen that quite a lot. This one. So when you have then modifications, so the examples that I discussed before, they have two possibilities. It can be that the modification will be considered as a separate lease. When do we have a separate lease? There are two conditions that need to be met. First one is there's an increase in the scope through adding a right to use one or more additional underlying assets. The example is, for example, a new floor. The example is a new machine, etc. But there's also a second question. A second criterion is that the additional lease payments, the increase in the consideration that you need to pay to the lessor because of this increase in scope, this needs to be at least equal, or need to be equal to the standalone price for the increase in scope. So if the lessor would have rented the additional floor to a third party, which didn't have another floor yet, would that be the same price? There's a little exemption also that you, of course, can consider here, is that the lessor in the case when a rent additional floor may give a little discount because they have less costs, because they have already an existing client, an existing contract, so they don't need to spend it to do additional expenses to have a contract with another third party, that you can deduct, of course, of the standalone price. That are two importance. If that's the case, you have two leases: the unmodified original lease and the new lease contract. That's an easy one then. But in many cases, that's not the case, and in that case, if one of those two conditions or both are not met, then you apply to a modified lease contract. So you will modify the original lease contract into a modify. So what you then do, and I will show you some examples afterwards, you will allocate the total consideration, the new consideration plus the old consideration for the remaining lease period, plus the new consideration lease payments for the modification. That will be your new total consideration for the remaining lease term, and you will allocate that to the full modified lease. You will calculate what's my new modified lease term. It may be, if it's a change in lease term, it may be a new lease term. And you will remeasure the lease liability by discounting the revised payments with the revised discount rate. It's a revised discount rate in that case. And then the change will be the new difference. You will do an adjustment to the right of use asset. It may be, and I will show you that sometimes you may have a gain or loss relating to, for example, a partial or a full termination of a lease. And the difference between the asset and the liability will result in a gain or loss that you will have to recognize. But I have also an example for that. So an example here, a straightforward one, I think, one that can happen a lot. I have a lease of an office space, and I'm renting 2,000 square meters, one floor, and I'm paying a monthly rent of 10,000 euro to the lessor. It's a 10-year, it's non-cancelable, and in year 6, we agree, because we have grown a lot, that we will lease an additional floor for 1,000 square meters of a space, and until the remaining period of time. So it's the beginning of year 6, so we'll have an additional 4 years to go, and I will pay an additional rent of 4,000 euro. And this rent reflects the current market price adjusted for the discount rate that the lessee receives, because they don't, something I explained, because they have less cost to lease it to an existing lessee than to a new third party. They don't need to do marketing costs. They don't need to spend fees to a broker, for example, or etc. So in that case, I think you see it already, this will be a separate lease because it meets the two criteria. It's an increase in scope, yes. It's an additional 1,000 square feet that we will rent, and it's the consideration, the additional consideration equals the standalone price for this office floor, adjusted for some non-incremental costs that the person has. Let's call it like that. So in that case, we have two leases, one for 2,000 square meters and one for 1,000 square meters. So if I'm then going back to my first example, we have the 3-year lease contract with the car. The quarterly advance payments, yeah, you know that. And at the end of lease contract, C has the option to exercise the purchase option or to extend the lease with 6 months. The interest rate is the same thing. And then on the 1st of October 2020, the lessee and the lessor agree to extend the lease term. So we have a change in lease term, and we'll have an additional year. So the maturity of the lease will not be 28th of February 2022, but will be 28th of February 2023. So what will happen? Let's go back to our GLC. I will have the example here, I think. This is the example here, what I have. Let me show what has happened to the GLC2. So what I have is that, first of all, I think I need to show you the new lease term of this contract. So what you will see is what has happened is that we have a new end date of the component. So there's an additional year calculated. We did a change to the contract, and we have also added new payments. So we have added the new payments here again for the period of 1st of March 2022 until the end of the new end of the new lease term. You can also see that there are two modifications that we did. You see here we first extended the lease term with 1 year, and we added it's a variable payment because it's an index-based payment that I have added for you here. All right. So how does it look like then? Again, in the contract, if I go, it was the 1st of October. So what you see is we have a change in payment and change in lease term, but there's an addition. What you see here is that we go from the net liability from 15,468 to 24,959 for that. Okay, so that's an increase, and that increase you will also see in the asset, and you see now that the it's going until 2003. Why it's 30? Because the 1st of March it's a payment at the end of the lease, and the system didn't calculate it here on the 28th, but on the 1st of March. That's why we still have here a little payment with 1 day of interest. Okay. So that's how it works. So if you then look to the difference to the slide, the difference is the lease liability. The new net present value of the new lease liability is 2.5%, 2,500 per quarter until leasability until now, 28th of February 2023. That's 900. The difference is 900 between the two is 9,489. We will do credit leasability and debit right of use assets for the same amount, and depreciate the right of use asset, the new carrying value until for the additional until 23. Okay, that's an easy one. But that's a bit difficult sometimes here, and I think in that case often you will need a tool to do that, and you can do it in Excel, of course, but have the same example. But now, instead of increasing the lease term, they will decrease the lease, and they will say, well, at the 1st of October, we will reduce the lease term, and it will end not on 2022, but 2021. So we will have a reduction of the lease term. And then it's not so easy, because we have a reduction of the lease term, we will have a gain or loss. And I will show you also first here, and then I will show you the contract. If I go to the selection, it's my component 3 that I had. What you see in here, again, I have a lease term reduction, what he's saying. So I'm seeing my lease term reducing here. It's with 9,000 and something. That's again here the net present value of the future lease payments, but on with 1 year less lease term. When I go to the asset, there you will see that he has calculated also. So we see the same reduction here happening, but you see that he has calculated a profit or loss. It's now the difficult and it may not be sounding very maybe in the beginning not logic, but at the end it is logic how it's calculated, the difference. Let me go back now to the slide. So what he does, the lease liability, that's your new net present value, 9,727. That's a difference. And then you will calculate what is now my right of use asset. It's not 9,727 because I have a partial termination of a portion of the lease. So we'll have to calculate the impact of that. What you then do, and that's a bit the difficult part here, what I will do, I will take the net carrying value of the lease before the modification. So if you go back here, I think it was depreciation. When I go here just before the modification, my net carrying value is 13,545. So I will take that and I will do a proportionate. So I will calculate, well, under the original lease term, as of at the date of modification until the end of the original lease term, I had 516 days. You can also do it, if you do it in Excel, you can also do it by month, for example, or even by year. Some people are doing it. It will not give a material difference, of course, but here also because the tool is doing a calculation on a daily basis. That's why we calculate on days. When you take, well, total until 2022, it's 516 days. But when I take the only until the 2021, I have only 151 days remaining. So the pro rata of 13,544 multiplied by 151 divided by remaining will give me my new carrying value that I would like to see, my new carrying value that I would like to see, which is the new beginning of my carrying value. The difference between my old carrying value and the new carrying value, the 13,544 minus the 3,964, this is the impact. This is the change in the right of use asset. What you see in here, 900,005, that's the difference. So, and then of course, debit need to equal credit. My difference is a gain on modification in this case. All right. That's something that's not so, which requires some calculations. It's not so straightforward that the change in my lease liability is a change also in my asset. Okay. Voilà, that's a bit. Some other considerations maybe to consider is a lessee or a lessor may agree on a modification to a lease contract that starts at a later date. So what I'm doing with that one. So for example, in the year 8, we start discussions for a modification that will also, the effective date will also only be beginning of year 9. So what I'm doing then, do I calculate it already in year 8 or year 9? Well, when you have signed the contract for the change in year 8 and there's no separate lease and it's an increase in scope, you will do the calculation and your modification at the beginning of year 1 when you have changed the contract. Then you will change and you will consider only, of course, as of year 9, the future lease payments. When it's an increase in scope and a separate lease, well, the new lease is, of course, remeasured and recognized at the beginning of year 9. And if it's a decrease in scope, the same thing like before, you will, as the basis of the date of the change of the contract, not when it's effective in the contract, you will do the calculations and do the impact. That's a bit about modifications. So I will give the word now to Anouk, who will guide you through the impact of COVID-19 on your lease accounting and also the disclosures.
Thank you, Sam. COVID-19, indeed very important with respect to IFRS 16, as even an amendment was published by the ISB relating to the issues and the practices that they saw with regard to COVID-19 and the impact on the lease standard. In fact, a variety of fact patterns was observed due to the COVID-19, and in practice that were rent concessions. Rent concessions can have various forms. Can, for instance, be an adjustment to the frequency of payments that you pay on a monthly basis instead of quarterly, for instance, or in the timing. It can also be a deferral of lease payments with then a catch-up over the remaining lease period or at the end of the lease period. Can be even a forgiveness of lease payments so that you have rent-free or rent reductions, in fact, on your lease term, in partial or in full. And so those rent concessions were either imposed or encouraged by governments, but in a lot of cases, these were also negotiated between the lessor and the lessee just due to the circumstances we know since COVID-19. If you have a rent concession, and then you can ask the question whether or not you have a contract modification. Now, thanks to some, we all know now what a contract modification is. And we know that in case you have a contract modification, you should use or apply a balance sheet approach where you adjust the lease liability and the right of use asset. If you not have a contract modification, then you in fact have an income statement approach where you adjust the lease liability through P&L. But whether or not you have a contract modification is sometimes, in some cases, judgmental and difficult. And that's also why the ISB came up with a practical expedient. We'll see that on the next slide. The amendment offers, in fact, an optional practical expedient. So it's optional, it's not mandatory to apply it. It's an accounting policy choice that you make to lessees to treat the rent concessions in the COVID-19 context as if it is not a lease modification. So if you apply the option, then you will not have to do the analysis whether or not you are or you have a lease modification in case of those rent concessions. So if you do not use the option exemption and you have a contract modification, so then you do the analysis and you have a contract modification, you apply the balance sheet approach. If it's not a contract modification, you do not apply the balance sheet approach and you account for the rent concession as if it is not a contract modification. If you make use of the optional exemption, which also needs to be disclosed if you do that, then you account for the rent as if it is not a contract modification. Now, in fact, the standard was published by the ISB before the half year figures needed to be available. But in the EU at 36/2020, the standard was not yet endorsed by the EU. However, we saw that a lot of companies already applied the practical expedient, as there was also in a publishment of the ESMA that they would not take it as a breach if you apply it already on 30/6/2020. So some companies applied it already for the half-year financials, others did not. But in fact, the ISB had it already published, but it was due to formalities not yet an endorsement at that time by the EU. Meanwhile, the standard has been endorsed also by the EU, so it needs to be applied, the amendment, at least for the year-end closings now of 2020. A little bit a refresher from what some thought, but I want to go into full detail. The contract modification, when you apply a balance sheet approach, can result, for instance, from a change in the consideration, like some explained. There you will have to determine the new discount rate for the remaining lease term. And a lot of cases with contract modifications, you will have to revise the discount rate. You will have to remeasure then the lease liability to reflect the revised lease payments using that new discount rate, and you adjust the right of use asset. But what is there a little bit contradictory is that in a lot of cases, the new discount rate would have been lower than, for instance, the discount rate at the transition date. And as such, modifications would have resulted in higher lease liabilities, even if you got a discount, even if you got a rent concession, which is a bit counterintuitive. In case of no contract modification, like for instance, a reassessment of a termination option, like some also explained, there you have not a contract modification. Also, variable lease payments come into P&L. And rent concessions or such negative variable payments, you can say, in some cases, those come into P&L at the moment they occur. So that's in fact also why they came up with the amendment. And what are now what is in scope, or what are the definitions, or when can you apply the amendment? In fact, it's for changes in lease payments that are a direct result of the COVID-19 pandemic and occurring within a limited time frame. So in the standard or in the amendment, there were 3 conditions. The first condition is that the revised consideration is substantially the same or less than the consideration immediately preceding the change. So the payments that you will have to do and future lease payments should not differ substantially or should be less than in the original contract. And so the conditions are cumulative, and a reduction in the lease payments only affects payments originally due on or before 30th of June 2021. So if you have lease reductions extended beyond the 30th of June 2021, you will not be able to apply the practical expedient. But if those lease payments reductions are only within that limited time frame, then you will be able to apply the practical expedient. And then the third condition is that there should be no substantive change to other terms and conditions. So this amendment, and you see it also in the conditions, is very specifically designed for the COVID-19 practices that were observed. If you apply that practical expedient, if that is the accounting policy choice you make, then you should apply it consistently to all contracts with similar characteristics and in similar circumstances. So you cannot choose for a contract where you have rent reductions due to COVID-19 and where the conditions are in place, that you do it for one contract, that you apply it for one contract and for another not. No, you have to do it then for all the contracts with similar characteristics and in similar circumstances. If we dig into detail then, and what can be a number of frequently asked questions with respect to the amendment, that if the rent concessions result in lower rents after 30th of June, can you then still use the exemption? I already mentioned it. No, so it's only for payments due on or before that date. If you have extensions beyond 30th of June of next year, then in that case, the rent concession in its entirety would not be within the scope of the practical expedient. And so also if you have then part of reductions before that date and a part is after that date of 30th of June 2021, you will not be able to apply the exemption on the entirety of the rent concessions. The second question, if you get a rent holiday of 3 months, which are added then at the end of the lease term, so in fact you get an extension of the lease term then with 3 months, can you then still use the exemption? There the answer is yes. So a 3-month rent holiday before the 30th of June 2021, but compensated with an addition or an extension of the lease term at the end of the lease, there you will be able to apply the practical expedient. In fact, they say it only changes the timing of the individual payments. So it would not constitute a substantive change to other terms and conditions. It's just a change in timing from now to an addition at the end of the lease term. The third question, should the right of use assets continue to be depreciated during the rent concession period when you pay no rent? So you have a period in which you pay no rent, but what do you do then with the right of use assets? Should those still be depreciated? Well, in fact, in the amendment, there's no guidance issued by the ISB. But what they say, or what the general guidance is there, that is if there is no modification, or you use the exemption, because if you use the exemption, then you apply the no modification approach, then you continue to depreciate, because of the fact that the rent concessions do not lead, or not always lead to the fact that the asset is not used. So you do not use or stop using the asset, and that's why you continue depreciating the asset. In case of a lease modification, but then you do not apply the exemption, both the lease liability and the right of use asset will be adjusted. And then, yeah, if you choose not to depreciate the right of use assets, that would even may result in impairment issue. So overall, yes, you continue depreciating the assets. If you get a discount of 3 months without a lease term without the lease term extension, should you then book the gain in one time? There, the answer is yes. They follow, in fact, the IFRS 9 approach, which will be the topic for the next webinar, IFRS 9, where you recognize a day one gain. But of course, it will vary case by case. But yeah, if you have a discount of 3 months, which is definitely there, then you can book the gain in one time. How should the gain then be presented? Financial or operating results, also there is no real guidance in the IASB amended standards. But yeah, what we see is that most of the lease cost is presented below EBITDA, like the depreciations on the right of use asset and the finance costs are below EBITDA. So it would make sense to present the gain also below EBITDA. But there's no guidance, and I think if you have good reason to do it differently, then it's also possible. If you apply then the new practical expedient, what are the requirements with regard to disclosures? Well, you should disclose the fact whether or not you apply the practical expedient, and you should also disclose the amount that is recognized in the profit or loss statement to reflect the changes in the lease payments arising from the rent concessions to which you have applied the practical expedient. So if you recognize an amount, a gain in P&L, for instance, due to the fact that you have received a rent-free period as a result of COVID-19 and you have applied that practical expedient, then you should disclose what amount you have recognized as a gain in profit or loss. With respect to the cash flow, the main effect there will be a reduction or even an absence of cash outflows for leases during that period of the rent concessions. And for the concessions that adjust the carrying amount of the lease liability, then you have no non-cash changes in the lease liabilities. But in fact, what we will see is that in a lot of cases, the cash outflows will be lower during that certain period or during, for instance, 2020, or even be absent. For the lessors then, in fact, for the lessor accounting, there is no practical expedient. Also, the new IFRS 16 standard did not change compared to IAS 17 for lessors. So there, they still apply the decision tree that is presented here. But what are then the main concerns for lessors? Because it's not about applying or not contract modification, and the reasoning is a lessor can have contract modifications during or also independent from COVID-19, and they should have an accounting methodology in place to deal with contract modifications. So it should be easier for them to apply the normal accounting. But what are then main concerns for lessors? That's in fact the expected credit loss implications. It can be, for instance, that a lot of customers have difficulties to pay their rent. So that can have an impact on the expected credit loss. And that's again IFRS 9, in fact, that they have to provide for. And also with regard to the lease income recognition. If a client's receivables when paying leases have ceased payments without renegotiations, can you then, or to what extent can you then recognize your lease income as a lessor? And so and also the revenue recognition based on the variable lease payments will be difficult. Think, for instance, about lessors that rent out shops or stores. During April and May, a lot of shops were closed. If you then have a consideration which is depending also for a part on the revenue of the shop, it will be much more difficult now to estimate what variable lease payments can be recognized in your revenue as a lessor compared to the past, because there is no historic information available due to these rare circumstances. And then other considerations with respect to COVID-19 and the leasing standards. You can also have non-lease components, and the difference between lease and non-lease components was one of the elements of the first session on IFRS 16. And non-lease components can, for instance, be cleaning services for the building, security, utilities that are included in your lease contracts. And in some cases, certain concessions may also be granted or negotiated for those non-lease components. But if there is no concession for the lessee, then you need to do ongoing payments for cleaning, for security, and so on. But that may result either in onerous contracts if the asset or the non-lease component is excluded from the right of use asset, because you have the choice either to include non-lease components or exclude them from the lease right of use assets. If they are excluded, that can result in onerous contracts. Because you will have to pay for the cleaning and security and utilities, for instance, but there will be no benefit against it, and that results in onerous contracts. Or it can lead to even an impairment of the right of use asset if the option was to include it in the right of use asset. So if the non-lease components are capitalized or included in the right of use assets, then it can even lead to impairments of the right of use asset. With respect to the discount rates, yes, the discount rates may not be appropriate for new leases in 2020 compared to the discount rates that have been applied, for instance, at the end of 2019, depending on what the impact will be on interest, the market rates, and the discount rates in the future. For government grants, they say if you receive rent compensations directly from the government for one or another reason, then you should apply the IAS 20. So that's another standard on government grants. So there you have to look then at that standard and not at IFRS 16, but that will be in the exceptional cases where you receive rent compensations directly from the government. It can be the case. And with respect to impairment then, depending also on the cash generating unit and also depending on the existing headroom before COVID-19 was there may be impairment indicators on certain right of use assets, also as explained with respect to, for instance, the inclusion of non-lease components in the right of use assets. If we then move on to disclosures, so here we will give you an overview of what disclosures need to be taken into account, not with respect to COVID-19 specifically, but in general for IFRS 16. There you will see that on the balance sheet, they say a right of use asset should be separated from other assets, so the owned asset, and a lease liability should be separated from other liabilities. But if you read the standards very cautious, then there's stated if the lessee does not present the right of use asset separately in the statement of the financial position, then you shall include the right of use asset within the same line items as the corresponding underlying assets that would be presented if they were owned. But then you should also disclose in which line item in the statement of financial position those right of use assets are disclosed. And then the disclosure should be a little bit more elaborated on what categories, for instance, are included there. So you'll see, and also in examples that come here after, that were, two methods and two practices also. Some companies present it either separately on the face of the balance sheet, others included often then in the property, plant and equipment, for instance, and then include disclosures within the notes to the financial statements to in fact give the same information as if you would present it separately. With respect to the income statement, you should separate the depreciation expense from the interest expense and vice versa. And you present or disclose the variable lease expenses, short-term lease expenses, and low-value asset lease expenses. You should disclose what amount you have recorded in the income statement for those practical expedients and variable lease payments. With respect to the cash flow statement, the principal payment should be included within the financing activities, and the interest payments, these should be presented consistently with the policy choice that you have chosen in IS 7 with respect to other interest payments. You present or disclose lease payments for low value assets, short-term leases, and the variable lease payments within operating activities, but in fact, that is often already included then in, for instance, the net result where you start from. And the supplemental non-cash disclosures of new leases should also be disclosed. If you have a look then at some practical examples, in a first example, this is in Dutch, but we have similar examples later on also in English. In the accounting judgments and estimates, you will also see, for instance, a description often on the determination of the lease term for contracts with options to extend or terminate. There you should describe what management's assumptions or estimates are and what judgments they have done in applying those extension options and whether or not these are reasonably certain. So you should describe a little bit how you came to the conclusion. Also, with respect to the estimation of the incremental borrowing rate, you should use normally the incremental borrowing rate implicit in the lease, but if that is not available, yeah, then you often will have to do also estimates on the incremental borrowing rate. And there you explain what you have taken into account to come to the discount rate for a number of categories. Then we have the consolidated balance sheet on the left-hand side of this slide. Here you do not have the separate presentation of the right of use assets on the face of the balance sheet. So here the right of use assets are in fact included in the property, plant and equipment. And then in the note of the property, plant and equipment, which is on the right-hand side, the upper table of this slide, you will have a column right of use assets. And so it's included not in the face of the balance sheet, but you present it separately then in your note of the property, plant and equipment. What you then also disclose, and that's the table on below the movement table of the property, plant and equipment, is the categories to which the right of use assets belong. So there you will split between, for instance, lands and buildings, vehicles and other material, or even more categories depending on how you present it for your own owned assets. And in fact, you will do a sort of movement table from one period to another. If we then move on to the financial liability side, you can present a reconciliation with the cash flow statement. So where you present what the repayments were of lease payments. Like in this case, for instance, there were lease payments for 815k euro. Well, that 815 will be presented on the next slide then as repayments of lease liabilities. What you also present is the interest expenses and also other expenses resulting from short-term leases or low-value assets. That is the table here, for instance, as an example on the table on the right-hand side, the lower table. So the interest expenses and the expenses from short-term or low-value assets should also be disclosed separately. If we move on to the next slide, there you see, for instance, that the repayments from the lease liabilities are presented separately. These should not be included in the repayments from borrowings or loans, for instance. These should be presented separately in the cash flow statement. And you can do a reconciliation with balance sheet and with by means of a movement table to other elements in the financial statements. On the next slide, we then have a second example. This is one in English, where we see, in fact, more or less the same elements. Also here, we have it on one caption, property, plant and equipment, so it's not excluded on the face of the balance sheet or separated on the face of the balance sheet. Also here, the expenses relating to the short-term leases and low-value assets are disclosed, however, not in the table, but just as a narrative. So there is no guidance on whether you include it as a narrative or in the table. You just have to include it. So as long as it is included, it's okay. So here at the left-hand side at the lower table, just below that, you see the expenses relating to short-term leases amount to 146k euro, and also for the low-value assets. If we move on to the next slide, then there you have the disclosure of financial debts, where you then have indeed, because also for the financial debts, in most cases you will see that the financial lease liabilities are not separated from the normal financial debt, but then again you should be able via the notes and via the disclosures to separate them. And so that's what's happening here. You have the total financial debt, and then in the notes they do a disclosure of what amount from that total is in fact the leasing debt. And here they split it then between current and non-current. But yeah, you have at least the separated leasing debt here. For the cash flow then of this example, again, you have a separate line because that's the requirement. And then you can, for instance, add also in the accounting policies some information on how the cash flow for the leasing debt was built up. In this case, they say the cash payments for the principal part of the lease obligation is included in the financing activities. The interest part is in accordance with the presentation of the interest payments chosen by the group. So in fact, they refer to the IAS 7 policy choice that they have made. And then the short-term lease payments and the payments for leases of assets with a low value, and also the variable lease payments that are not included in the accounting of the right of use assets, they are included in operational activities. So that is indeed what we expect, but here they describe it also in the accounting policies. And then we have an example, the third example, and here this is an example where you see on the face of the balance sheet on assets and liabilities a separation of the right of use assets on the left hand side, and also of the lease liabilities on the right hand side of the table. So here they opted not to include them in the property, plant and equipment, but I think it depends on how or in what information the users of the financial statements are interested. In this case, it's a company with a lot of right of use assets, and that is for they. It's very important to have it separated on the face of the balance sheet. So that's the alternative method that you can use. And what they also disclose in addition, and that you can see on the next slide, because there is a paragraph in IFRS 16 that requires you to include exposures that arise from variable lease payments, extension options and termination options that are not included in your right of use assets, residual value payments, and also leases that you have not commenced but to which the lessee is already committed. And that's in fact what they disclose here. So on the left-hand side, you see that they talk about contracts, leasing contracts that will start as from 2020. So these were the financials of 2019. So they talk about contracts starting as from 2020, but that were not yet recognized on the balance sheet date here. But then they say what amount will be related to those commitments, in fact. So these are in fact the lease commitments for which you have that are not started yet. So in this case, it was 22.4 million of non-discounted lease payments or future lease payments. And then on the right-hand side, they will also disclose what amount you will have to pay due to possible extension options that you did not include in the right of use asset because you estimated them not reasonably certain to exercise, but at least they disclose what if they should have been included, or what if we exercise them, and what would then be the total amount that would be added to the right of use assets. So that is the disclosure they make here. Then I came to the end of this session.
Okay, Anouk, thank you. It's amazing that we're always right on time at the end of an hour and a half almost. I think the presentations were very clear because there are no questions. So I assume that we explained it very clear. So first of all, thank you all. I would like just to still invite you to maybe subscribe to our next session here on IFRS 9, which you see here the days. Go to our website and there you will be able to subscribe, where we will explain IFRS 9 not for financial institutions, but really for companies like mostly you all. That what are things that you may be faced with from an IFRS 9 perspective. So thank you all, and take care and have a good day. Bye bye.